welcome to this session, FPAS Mark II and commercial banking. We think of commercial banks as being a very important intermediary in helping us to take our transparency and to spread it so that when people go into banks and that are looking for other loans or perhaps some advice about how they might invest, that there is some knowledge inside the commercial bank that helps provide information to their customer base. But of course, we also have to interact with commercial banks because we have very simplistic representations of the monetary policy transmission mechanism. And to really understand what is going on in an economy, one has to understand what the thinking is in commercial banks. So I'm very happy to have Otar, who I've worked with in a previous life when I was doing technical assistance, developing the monetary policy framework there, as well as Arik and Narek and David from the Central Bank of Armenia, as well as Hike on my left here is also at the staff level at the Central Bank of Armenia, but has some experience thinking about these types of issues, and in particular, what we do under FPAS Mark II and so on. So I think it might be best to start with Hike so that everybody understands what it is and what we do under FPAS Mark II. So please, Hike.
So hello everyone, and thanks, Doug, for introduction. So I think I will start by setting the stage. What are the key elements of our new monetary policy framework, and basically how it provides a better role for financial market participants compared to our previous framework. So for those who don't know me, I am Hike from Monetary Policy Department. I was responsible for conducting the projection rounds and basically was the first person to run the production cycle under this new monetary policy framework when it was launched in 2024. So first of all, let me talk about the key elements of our new framework. Obviously, FPAS is a holistic approach of policy making, basically touching every aspect of policy making process, including the underlying capacity development processes inside the central bank, like the human capital developments and so on. So it's kind of a very comprehensive package, and I'm not going to delve into very much details of it because yesterday Vi and Angela talked about it in more details. But what I think is FPAS Mark II is more about communication. First of all, it's about communication. And this is the key aspect where central bank and financial market participants interact with each other. So it's worth stressing the key elements of monetary policy communication that has changed dramatically compared to the previous approach, which you will understand that it envisages in the end a better role for financial market participants compared to the previous approach. So I think in general, the communication of central bank has become more clear and more transparent and more honest by adopting this new framework. And it serves to its purpose because the ultimate objective of monetary policy communication is to convince the financial markets and other stakeholders about central bank's commitment to its price stability objective. And we also want to make sure that the financial markets really understand how the decisions are made inside the central bank. And I think that this new framework is very much aligned with these objectives and basically making the central bank as one of the most transparent and accountable central banks around the world with respect to monetary policy communication. So let me talk a little bit about motivation, why it was necessary to change the framework, and Then we'll turn to key elements of our framework that has changed dramatically compared to the previous approach, also stressing the parts that are more important for financial markets. So for the sake of illustration, I want to bring an example to explain better why we changed our framework. We spent a lot of time on traveling from Diligent to Yerevan, and I guess you have seen many pictures of this road in the presentations from our staff, because not surprisingly we spent lots of time on that. And for those who doesn't know, the road, there are some curvy parts where you climb to the mountains, and there are very dangerous sections of the road. So, and we like to think about monetary policy like inflation objective by thinking parallel as a trip from Diligent to Yerevan. So imagine a sunny, like summer day with few traffic, with less people, like everybody's on vacation outside of the country. If an accident happens, the road clears quite fast. And in this type of situation, like you can maybe with more than 90% accuracy can approximately estimate how long it will take you from getting from Diligent to Yerevan. And in the opposite, like imagine a foggy winter day with minimum visibility, with lots of accident and lots of traffic. And if something happens on the road, so it takes quite a lot of time to clear the road, and you don't know what is expecting you on the way. So in this type of situation, like as a driver, you become more of a risk manager, and because you try to ensure you from some major risks taking place. For example, you may care about not hitting the car or not falling into the forest. Basically, you may try to start your journey a bit earlier in order to manage, in order for time management purposes, to manage the risk of being late, or you may drive your car a bit far from the edge of the road in order not to fall into the woods. So basically, in this type of elevated uncertainty, I think your role naturally becomes one of a risk manager rather than an expert forecaster who can predict like the duration of the trip, which basically doesn't have any value added in this type of heightened uncertainty environment. So I want to mention that since 2020, Armenia has rarely seen like sunny days like I described. So the COVID, war in Nagorno-Karabakh, political instabilities, war in Ukraine, geopolitical tensions, and so on. So we ended up in an environment where the uncertainty has become a new normal in our world. And basically what we have done is to incorporate this uncertainty or endogenize it by systematically incorporating into our decision-making framework and make monetary policy as more of a risk management exercise rather than being central bank who is an expert forecaster. So of course, the risk management approach is not something new, and we didn't invent a bicycle from scratch. So it was used historically by many central banks around the world. But what we have done is to institutionalize that approach. So the first element that has changed dramatically in our new framework is the removal of baseline. So we get rid of the baseline projections because simply, as I mentioned, baselines don't have any value added in this type of environment where uncertainty is quite elevated. And actually, the baseline doesn't have anything to do with the policy. So instead, what we are trying to do currently, the staff puts too much effort in order to understand what is really priced in the markets. So this is basically similar to the baseline, but it's the market's baseline. And also the staff puts lots of emphasis in order to understand what is not priced in the market, but it's really important for monetary policy making process for the board members. So these are so-called case scenarios or risks that are communicated within our external communication documents. So a scenario-based framework was developed to illustrate the systematic incorporation of uncertainty into our framework. And then basically it helped to be more prepared in case like these scenarios unfold in the future. I want to mention that removal of baseline has quite important implications for the general communication approach of the central bank, because previously the baseline approach was perceived in a paternalistic way of communicating with the financial markets. So basically what we are saying is that we know what will happen in the future, and financial markets, we say that just follow our baseline projections. So it has some issues in it, because obviously it's the honest way of communicating with the market. Surely we don't know what will happen in the future. And second, it crowds out the private information. So people will simply just take the baseline projections and didn't want to try to invest in their capacity development processes and try to make their own macroeconomic projections for various reasons, like for risk management purposes, for strategic decisions, and so on. And now what central bank, what we are doing currently is honestly communicating with the market that we don't know what will happen in the future, and maybe maybe financial markets, you can provide a better perspective on that. So it's more of a interaction and a collaboration with the financial markets instead of a guidance. Yeah, because simply financial markets have better access to data, and simply they work more closely with the real sector compared to the central bank. So what we try to do instead, we are trying just to communicate, to explain the underlying decision-making process at the Central Bank of Armenia, and we expect some feedback from financial markets in terms of their expectations about future policy rates based on their own assumptions about economic drivers and their understanding of how policy decisions are made inside the central bank. And the last element is the key, that we want to make sure that financial markets really understand how the decisions are made inside the central bank. So I also want to mention that previously the staff, we also fixed some ownership issues by removing the baseline, because previously the staff has some agenda setting power by producing the baseline. So in the end, the baseline has nothing to do with policy, but it was very powerful because it was the key element of our external communication documents, and it has some power to influence market expectation. That's why there were constant issues with the baseline. Everyone wanted to put their own views inside the baseline, and so on. And in that sense, the staff had some agenda setting power in the end. But now the role of staff has evolved, and the framework is like fully centered around the board. So basically, both around the board and around the market expectations, let's say. And everything that you can see, like the risks, uncertainties that are present in the external communication documents, these are all reflecting the board's beliefs and concerns. The staff doesn't have any powers to affect these beliefs. And we went even further and didn't allow the staff even to have beliefs. They just need to make to have multiple heads on their heads and try to critically assess both case A and case B type of scenarios at the same time. So in terms of the decision-making process, if you think about the previous approach, like in a very, very simplistic way, So it was more, the baseline approach was more consistent with the inflation forecast-based reaction function, where basically you try to react to underlying economic conditions and expected inflation by adjusting your instruments sufficiently aggressively in order to achieve price stability objectives. What we are doing currently is something different. So instead of trying to find an optimal path for policy rate, the policy is oriented towards keeping economy away from some costly states. So basically, this is the least regrets approach to monetary policy making. And it has two elements in it. One is the probability of an event that an individual board member is concerned, and the other one is the cost associated to that event or concern. So the overall assessment is based on these two elements, or basically the multiplicity of probability and the cost of an event. And you can notice in our external communication documents that in some cases, for example, in the latest report, that the board states that although it thinks that the case B type of scenarios are more probable, but the costs associated with case A type of scenarios are significantly higher. That's why they are more concerned about like case A type of risks. So in my example with the car, maybe you can think of falling into the forest. It's the worst case scenario. So you don't care about hitting your car, but you are more afraid of falling into the forest. So you might drive your car a bit far from the edge of the road in order to reduce the probability of these scenarios unfolding and practically getting into these dark corners. Also, in terms of the guidance to the market, I think, again, the baseline approach of communication was more consistent with conditional forward guidance. Basically, what we say is that we know what will happen in the future, and you just follow this line to the markets. And instead, the communication, the accent of the communication has changed to, we don't know what will happen in the future, but we are ready and we are committed to react in any case to bring inflation back to the target and to achieve the price stability objectives. So some may say that this approach might create a bit more uncertainty in the short term in terms of interest rate volatility in the markets, but we think that it's a justified uncertainty, a justified volatility, because obviously the baseline is not the correct way and honest way of communicating with the markets. It's just a false assurance to financial markets. And by scenario-based guidance, I think we can achieve a better nominal anchor in terms of inflation expectations in the long-term horizon. So there are also other aspects of the framework that are touched in detail during yesterday's presentations, and I want to delve into that too much in detail. I think I covered the key aspects of communication that are very important for financial markets, and I will stop here to let others to speak. So thank you for your attention.
Thank you, Haik. So I think what we'll do now is move to Otar. Get your reactions to FPAS Mark II and what it means in either Armenia or Georgia, because Georgia is about to do it. And so what are your thoughts about FPAS Mark II and this issue about communicating with central banks and so on?
Yeah, thank you very much. Thank you, Douglas and colleagues, for this opportunity. As an introduction, I have to say that I regret I am not in Dilijan. I recall my last visit and great hospitality, great substance, always very interesting events in Dilijan. So today is Friday, so I will compensate at least Armenian brandy or Armenian wine. So I will find it in Tbilisi. So hopefully I will join you next time. So thank you very much. This is very interesting. Douglas, thanks again for your valuable technical assistance now and a few years ago, of course. So I think, in my view, it's for commercial now, from commercial banking perspective, it is very interesting and useful approach. Again, as mentioned. I would confirm that maybe bankers also, corporates, etc., they perceive central bank baseline as sort of very accurate forecast, which they will and have to follow. And another question is, as mentioned, that creates problems for them because in many ways, it's Roger Martin from Harvard University. I mean, he argues that in many cases businesses have plans but not the strategies. Yes, so in this context, it would be sort of for businesses like plan. You have the baseline, and then to adjust, its financials, etc. But as you said, basically. Life is difficult and complex, and we don't know. I mean, we also do forecasting now with commercial banking, and we don't know what's gonna happen. Of course, I would still argue baseline is something important to have, but to have multiple scenarios, this is very very important and interesting. And I will provide few examples. Of course. Very important for commercial bank like systemic bank like TBCs in Georgia or Ameria and other banks in Armenia. So we do a lot of stress testing scenarios like budgeting, ICAP, recovery, sector concentration, etc. And at the end of the day, very important is what you do about the results. Yes, because if you agree, in many cases, it's just you do scenario, you have losses, and like stress scenario, and then the problem is what you do about that. So one example I was sort of thinking of is I think it's fair to argue that at least in a way, if you think about policy rate, well, in countries like Georgia and possibly Armenia and other similar countries. So in a way, sometimes monetary policy is pro-cyclical. Yes, so that means, unfortunately, maybe for good reason, but unfortunately, often in bad times we have higher rates. Yes, if it's two good times, we have also high rates if economy is overheating. But if you are somewhere in the middle, so basically you have probably something close to neutral rate. So. And by the way, this does not mean necessarily always policy rate hike, but often that's the case because now we are in the reality where policy rate is flat, but you have huge spike in deposit rates. Yes, so and sometimes it happens through interventions, what I call tightening through interventions. So that happened very recently in Uzbekistan. So if central bank is selling reserves not in the sterilized way, that also effectively means tightening. Yes. So again, one example to be short. So if with some level of certainty you have multiple scenarios from central bank, and the guideline is that if GDP drops, you have high depreciation, external shock, whatever. And in this case, if you have higher rates, let's say in national currency. So that helps commercial bank, depending on its risk appetite, to adjust. So for example, if you are in easing cycle, so you may adjust your interest rate risk position in the banking book in a way to benefit from declining rates. Yes, I mean conventional wisdom is vice versa, but still. But if you assign more weight to adverse scenarios, then being a commercial bank, and I'm saying very practical and real example. Yes, if in adverse scenario you're gonna have higher rates in national currency. So then you may decide again, depending on your, I would call it macro risk appetite, that okay, I may decide that I may not benefit from declining rates. I may even have losses from my banking book interest rate risk position. Yes, but this is desired because if interest rates go up, so I will have some balancing impact from that channel as compared with exchange rate, NPLs, etc., etc. So in that context again, having multiple scenarios, I think it's very useful and very useful for the real sector, of course, non-financial sector. So the case we were discussing in Tbilisi during a very interesting event, again, on broadly same topic. So we were discussing the case for residential real estate company. Okay, if they have just a plan, central bank baseline, and they say that okay, maybe I mean, central bank is not necessarily always provide exchange rate projections, but still, if they don't perceive, of course, in baseline some adverse scenario, and that's the case, yes. So they might assign lower weight for stress scenario, but if they see that in case of adverse scenario, like the example we were discussing, the real estate prices after depreciation might go down in USD and frankly and interestingly might go up in local currency because of not 100% pass through. Yes, controlling for other variables. They might decide, okay, we may borrow partially in gel because that's basically important information for us. So again, overall, also I would add that putting too much emphasis on baseline also may impact, as argued very well on central bank, may impact central bank reputation because one case is from my perspective when commercial banks sees central bank providing only baseline, but another case is, as you said, is that we are in uncertain environment, like in maybe now more uncertain, but like always. So that's why I think it's fair. I would say it's fair to argue that we don't know what's going to happen tomorrow. So basically, those are different or multiple scenarios, and those are at least major macro variables and our policy response. How that would involve in those scenarios. So again, of course, more needs to be looked at in practice, but I think the approach is very interesting and potentially creating real value for the financial sector and non-financial sector.
So thanks. I'd like to start off with a specific question before I also turn it over to the rest of the participants. Last night, we had Bill White here. And Bill White and I share this idea that there is a very significant chance that we're going to have a GFC2 over the next 5 years, like a chance that is not priced in financial markets. I don't believe it's priced into the plans of many corporations and banks and so on. But what are your views about that, Otar? Are you concerned about a scenario, for example, where there's a crisis in confidence that interest rates, the 10-year bond rate, rises to 7%? So it becomes totally evident that people in financial markets realize that the fiscal dynamics are unstable. Equity prices crash at least 50% in the United States, maybe more. So a crisis in confidence where you have both economic activity, global economic activity falling, and interest rates being higher. So we're not used to that. Okay, we're used to living in a world where if bad things happen, we can have lower interest rates. But there's this potential scenario, given our debt dynamics, that if the crisis in confidence is about those specific problems, you could have a collapse in the economy with even higher market interest rates. And of course, the central banks would try to bring those interest rates down by monetization, which would mean more inflation, which effectively mean that longer term interest rates would go up even more. So, they would be trying to use the short end of the curve. So the question is, when you go through your thinking about that, looking at the risks on the balance sheet of your banks, you have to look at the interest rate risk in this scenario, because the capital losses for banks that had gone really long on their loan portfolios or on their security portfolios. But what are your views about this scenario? There was another view, David Aikman, who was also on the panel, was making the point that banks are much safer today, they're much better capitalized, and so on. And then Bob Ford at the end of the panel said, how much do we really know about banks? How much do the outsiders really know, and how much do the regulators really know? So, what are your thoughts, Otar? If we could just start with you, and maybe you could kick it off, and then we could ask the other participants to chip in.
Yes, definitely. Probably that's good example. I would say where the sort of the way of thinking and mind differs if you think about central banker and commercial banker. Yes, because so in that regard, I'm still central banker. So what I want to say is that it's famous saying that all bad loans are from good times. Yes, so there is no bad loan from bad times. Yes, all good loans are from bad times, and of course. In general, I mentioned procyclicality of monetary policy, but not necessarily for bad reasons. But in general, private sector is of course pro-cyclical, and I would say, of course, to the reasonable extent, but Georgia is not an exception. So you asked about US. So in that context, my answer is yes. I mean, if you look that. I would say it's not about soft landing. It's not. There is no landing at all. Yes, if you put in this way, I'm not. I have to say I'm not really seasoned in stock valuations, but I believe in overvaluation argument. I mean, if you look at previous episodes, also basically. The growth is or at least was largely financed by, if you are talking about US continuous fiscal deficit, yes, which becomes very large. So again, if in my view, just to answer your question, in my view, yes, the longer we have the call it boom or good times, yes. More severe the adjustment at least can be. Yes, at least can be. So, and of course, high levels of debt and as you argued, monetization. I mean, all those are very important things to consider. Yes. So basically, in our scenarios, likewise many other risks. Of course, it's a long story. So. Whether we have this in our stress test scenarios, yes. Basically, we have. Frankly, I am asking myself, maybe at some point in the future, dollar may become the emerging market currency. I mean, in a way that when you have trouble in exchange rate, you have higher rates. Like in USD case, you know it's vice versa. Yes, but maybe maybe due to many reasons that could be that could be the case that you have, as you argued, high rates, but at the same time exchange rate weakening. Yes, like it happens with gel or with ruble or many other currencies. Yes, so now whether we have this in our stress tests, we have more conventional scenario with high rates, global slowdown, USD safe haven, and like USD appreciation, etc., etc. Yes, so we have this, and of course. I agree. Like your question were very relevant. Whether we know sufficiently, whether we are sufficiently informed about banks, and I think Silicon Valley Bank is just example. I mean, you can't have more better if it's good example. You see what I mean, because I mean the risks there was something. Probably student doing his or her bachelor's degree would understand, and it is really uh, surprising, how that risk could be missed. And by the way, in this context, I mean, if we try to link the multiple scenario approach, yes. So but at that time I was reading some self assessment from the Federal Reserve, and they ran the stress tests, yes, but in their stress tests, basically also communicated with Fed. Normally in US, in adverse scenario, you have lower interest rates, yes. So basically, when you have adverse scenario, and that's basically that was the main scenario employed by the Fed in many contexts. So basically, you have lower interest rate, yes. But I mean, if you have such a high interest rate risk exposure, not to think what's gonna happen to us if rates would go up. Of course, that's basically something unbelievable. Yes, whether on the bank side or on the regulator side. Yes. So overall, yes, yes, I believe that. I mean, if there was X probability, I don't know when, but call it a few years ago, just not to focus on the concrete developments, unfortunately, in Ukraine elsewhere. So the probability of global slowdown, or call it severe adjustment, is much higher. Is of course much higher. Yes.
Thank you, Eric. Perhaps the two questions, if you could take them together.
Okay, thank you. First of all, I would like to mention that, as Haik said, it's not a secret that we live in a world where the new normal became the high uncertainty around the economic developments, what's going on in the geopolitical arena, and translating these risks into different scenarios and thinking about the decision-making process from this perspective is very important, and it is not important just for central banks, but also for commercial banks. And this risk management approach is a very valuable input for us too. And here is where FPAS Mark II has brought real progress for us as well. Because now when we can more transparently see how the policymakers think about the inflationary and deflationary so-called case A, case B scenarios and risks associated with them, we can also assess, are we in line with policymakers? Do we share the same assessment of the risks? And this really helps us to make not only the daily risk management process more efficient, but also to think about it more strategically while developing the bank's strategic development plans and forward-looking guidance. Of course, here I want to emphasize the importance of more transparent communication of central bank, because now when we have access to what each of the board member of the central bank thinks about the risks and how they see the future path of the policy rate, and also how they assess the so now we also have access to the overall market expectations, and it is very valuable input for us to see not only like what Commerzbank separately thinks about the policy path, but also what other banks as a whole, the financial system thinks about it, and how the central bank creates its case A and case B scenarios based on these market expectations. Are we in line with them, and are we capable to react to possible developments? Those are questions that still need some improvement, because like traditionally Central Bank of Armenia has been leading research center also for commercial banks with its institutional potential, forecasting and developing different scenarios, of course concentrating on baseline scenario, but commercial banks has traditionally used these scenarios. Now with this risk management approach, we also have this opportunity to go deeper with different risks and understand how can we deal with them. And it creates room to further develop also the capabilities, the potential of researching commercial banks. And that's what we are looking for. And just to sum up, I think now with FPAS Mark II, monetary policy became more dynamic, more transparent, and more collaborative, and addresses commercial banks' balance sheets risks better, because you know about recent economic developments like war in Ukraine, a lot of influx of capital and human influx into Armenia, and just the geopolitical and economic developments, of course, that influenced the bank's balance sheets, its profitability, the liquidity. And with this new risk management approach, we can better address these issues and understand how should we react in the future in case of this or that risk being materialized. That's all.
That was wonderful, Eric and Otar. The question I want to ask you guys is that there's an aspect to what we do that concerns, in particular, global risks, where it seems like there could be big benefits of sharing, in other words, collaborating in certain areas with other commercial banks. In fact, not even necessarily other commercial banks in your country, but possibly others in terms of developing the training and so on. So I was wondering if both you, Otar, and Eric could just talk a little bit about like the groups that you've developed in your institutions and how you've trained them and so on, and is there any AI in that training at this point?
Yes, thank you. So, unfortunately, no AI in macro. I mean, we do some chat GPGs not of course sufficient, and we had already discussion with you on this matter. And by the way, one project in commercial banking developed by Armenian team, maybe they are here. I don't recall their names. They really did a very good job analyzing the Armenian banking system. So, but we try to develop more in this regard. So, second question: how our unit at commercial bank is organized? So, in case of TBC group, it's a largest financial group in Georgia, and also with very rapid growth in Uzbekistan. So I am a group chief economist, so responsible for everything what relates to macro, basically within the group. So in that context, I would say, there is no Chinese wall, call it, but our unit is still divided in two, call it, directions or divisions. So one is purely macro. So purely macro, I would call it one focused on macro publications, inflation projection, I don't know, policy rate projection, etc., etc. And another is more, call it, macro financial. So how all this is relevant for the group. So in central bank language, it should be something like macroprudential, if I'm using right wording. You see what I mean? But at commercial bank, so more, equally from risks, but also from opportunities perspective. Yes, because if you are central banker doing macroprudential, so basically you are more focused on risks, of course. None of central bankers would say that they don't focus on development, but still, what I mean for a good reason, of course. But in our case, of course, this is focused on more also on opportunity and risk. So to give you an example, so what would be maybe the most short example? So think about wages. So wages, how that impacts inflation. So as an example, yes, unit labor costs, etc. It's more, I would call something like purely macro. But then how wage growth and projection impacts, let's say, retail credit growth, and what top-down projection you should have for retail credit growth, which also we do within the group, whether it is Georgia or Uzbekistan. So it's more what I call macro financial, not macro financial in more academic way internationally, but how macro impacts the financial institution. So that's basically our structure. Of course, those units work closely together, and of course, the group responsible for more impact on the bank, or call it, or people like to call now tech companies. Yes, at least we have ambitions that we have something like this in Uzbekistan. Certainly, probably not in Georgia. So overall. So that unit cooperates very closely with different business lines, risks, as well as corporate, SME, retail. So Douglas, you mentioned the interest rate risk, like financial risks, unit treasury, etc., etc. So that's basically how we are organized, and of course we use. And we cooperate with the National Bank of Georgia, but for scenarios, whether it is stress test, baseline, or also the IFRS 9 scenarios, we rely on our own scenarios. Yes, also approved by the external audit. One exception now is the climate risk. We will follow, most likely in that context, scenarios published by the NBG very recently.
Thank you, Otar. We wanted to use this first session to really hear from commercial bankers and so on. And we have a coffee break in 5 minutes. So if you could take the remaining 5 minutes, and when we come back, we'll turn to some of the board members that will react. But I guess I want to ask you one more question. Both your banks are big banks. And so I guess my question would be, you know, when you're thinking about doing it in your bank, how would it be different in a smaller bank? In other words, what advice would you give to a smaller bank if they were starting at it, you know, and they had less resources and so on? But please.
Very good question, especially the part of separating between big banks and small banks, because first of all, let me say that it is really very important to understand the underlying macroeconomic and financial linkages. So how the developments in the global economy can translate into the country, and from the country to the financial system as a whole, and then translate to commercial banks as micro elements, right? And here, sure, we should understand if the bank is a big one, so it has different business lines like corporate business, retail business, investment banking, or it is a small one, not a universal one, and concentrating on some specific area of the commercial banking, because it will differentiate between the needs and the understanding of the whole what is going on. For us as a big universal bank in Armenia that has its many branches in different regions and also is in prudent places in both corporate business and retail business. So we deal also and investment banking. So we work with investors, we work with individuals, and we work with legal entities, and understanding what is going on in the economy that can translate to these particular segments. It's very important, and within these situations, it is very important to understand what kind of impact this or that kind of risk can have on the whole and on the different segments separately too. So we try to address these questions with our research, and if needed, go to very micro level to identify the what we need to do in this exactly scene.
So my understanding, Otar, is that you've got a little presentation also on exchange rate. Is the plan that you're going to present that? Because Ike was moderating this, and I was informed that he was ill. So
okay.
Are you doing this talk on exchange rate, this interesting issue? Or
Yes, I don't have I was not aware that there is a specific time, but I have presentation. I presented elsewhere at EBRD, so I can present that one. So it's basically on if you mean that one on optimal funding structure, so incorporating macro. So how we would incorporate it macro in decision making when let's say corporates take loans in jail, foreign currency, or euro, dollar, etc., etc. I can certainly do that. Yes, yes.
But can you do that in 20 minutes?
Whatever time is, yes, I'm happy to do this. Yes.
Okay, good. So let's
sure.
plan.
Yes.
We'll come
Okay.
back in
Okay.
when the coffee break ends, and we'll start there, and then we'll provide feedback. Okay.
Okay. Okay.
Thank you.